Morning, Chris.
Good morning, my friend. How are you?
I'm good. I'm Brian Jones. I am here with Chris Hood, professional options trader, world's most interesting man. And what do you got going for us today, Chris?
Man, I tell you, I've got to get this hair out of the shot because I'm actually getting more frightened looking at my own face. It's just horrible. This COVID thing, I've got my vaccine scheduled. I'm ready to get the stab. I
Yeah.
can't wait, man. I can see my life returning back to normal. I'm looking forward to choking some people out, getting back into the groove. It's actually going quite well. I think that now that I can see the light at the end of the tunnel, it's a little easier to cope with being locked up.
Right.
So, it's going good. The
So have you had,
markets at the moment are just phenomenal. Like
yeah,
really awesome. Yeah,
it was a good
absolutely
day
phenomenal.
yesterday.
It was, the thing that sort of captivated the headlines over the last couple of weeks has been Bitcoin. And interestingly, a couple of days, that big sell-off that we had last week.
Right.
I was on a webinar the other night and I was listening to some of these crypto experts talk. I mean, I'm not an expert on crypto at all, so I'm quite fascinated with the whole, can it really be a currency debate? Because there are obviously things that make it not a currency. Um, but they were saying that something like 400,000 retail accounts got blown up. And when you start investigating this a little more, because I was intrigued, like this is a lot of people that are negatively affected by it. Turns out some of these trading firms were offering 100-to-1 leverage. And I was just like, that is nuts. And they're giving it to
Wow.
people that have got no idea, like literally no idea what they're doing. And you start asking yourself, whether or not this has got one of those, is there a sort of degree of culpability that sits with these trading houses and how they make things a little easier for you to lose money. So 400,000 accounts blowing up. And you sent me that meme the other day about that dodgy millionaire
Yeah.
who was held at gunpoint, right? Well, he's just lost a whole lot of money. So I wonder how that lady who's now going to be mothering his child feels that he's just lost half of his money. The world has certainly gone nuts. I think it's a degree of how much you've been locked up. But as you start seeing more and more retail people getting more involved in the trading game and having easy wins, there's an expectation that this is the way it actually is. But unfortunately, the reality is it's not. And there was a story I read this morning about a guy who lost out on Bitcoin or Dodgy or whatever, and he's now taken his life savings and put it into a coin it's called Australian Safe Shepherd, and its acronym is the ASS coin. And you sort of have to look at that and go, okay, if you're mortgaging your parents' house into something that's got an acronym called ASS, you only deserve to lose on that basis. So
Wow.
it's been really interesting. I think that there's some certain micro dynamics that are forming in different sectors at the moment, that if you can get ahead of the curve, there can be some
Mhm.
really, really awesome trades. I mean, we've got an awesome trade on in gold. We've got a trade that's on in silver. We've got a trade on in Google at the moment. We've got a trade on in Fortnite. We've got a massive trade in terms of return, 4,000% on a trade in FireEye at the moment. And it's definitely a sort of a little uptick. Let's just say some green shoots in the technology space. And what we're seeing is China is sort of putting a little bit more pressure on the commodity space. If you're a socialistic sort of dictatorship or one-party state, the last thing you need is 1.5 billion residents getting annoyed because their rice bags are getting expensive. So the Chinese government is putting a lot of pressure on the commodities to get cheaper. With that, it's going to bring down the inflation argument on stocks, right? So you've got this anti-inflation sort of segment that has been punted over the last couple of weeks around the commodity space. We saw what happened with lumber a couple of days ago. So you'll see some of that rhetoric around inflation coming down. You'll see the Fed talking it down a lot. that will suppress certain areas of the market. And what it's going to do is it's going to let tech turn around. And the tech turnaround is really where you want to play. We saw a massive move on semiconductors yesterday. So, our clients, we've been buying into SOXL, which is the triple leverage semiconductor stock. We've been buying into it in the shares, not the options though, for the last couple of weeks. Because what we were looking at was at some point the sort of selling has to end. And this is the hardest stock in this is Tesla, because Tesla is not a semiconductor stock, but it is so chronically oversold. And you have to ask yourself, at what point does it suddenly go, okay, guys, enough is enough? It's, shooting up. And it's at that point you want to be in the trade. I was talking to some people the other day, and I was just saying, there's certain stocks that you can't get into them after the move happens. You have to get into it before the move happens. So there's a certain degree of conviction that you have to have when you go into it. We started that with our gold trade, a couple of months ago when we started to see that double bottom form. We were like, you know what, this is where we need to be playing, because at some point the sort of macro story starts to bring it in. So this week's been pretty interesting. I certainly think we're going to see some movements in tech. I think we're going to be seeing some sort of pullback a little bit in the commodity space. It doesn't take away the rise in commodities. I think that the medium-term trend is definitely
a long medium-term play.
Yeah, you want to still stay with the inflation argument for now. Crypto, the credibility's gone. It's to me, I think it's a sunk boat for now. You've got to be, if you're going to trade it, you've got to either have gonads that are like, nuclear reinforced, because I think that the selling's not finished. I think it's going to be, I think there's another level lower, possibly into the 30s.
Do you know a lot of crypto traders, or some?
Not really. I don't hang around with a lot of them. I find the crypto space is quite specific. It's quite a specialized area. I'm not smart enough to deal with it. I still battle to get my head around the whole solving of a puzzle kind of thing. Like, and the fact that there was this guy who's anonymous who created a puzzle, and the reward of the puzzle is a coin. It sounds a little bit Dungeons and Dragons for me. Like, I don't know. I was never a sort of game kind of guy, but I'm happy to be convinced. I don't think I'm smart enough to get it. I think it's a very modern kind of concept. For me, I'm old school. It's like, I like to see the gold. There it is in the ground. That company over there gets it out for this much. That's how much they have. Whereas with the crypto thing, I don't know. I think there was an argument about crypto being a replacement for currency. And I look at that and I go, I'm an economist by trade. And I look at it and I go, well, one of the elements of that currency is the ability for it to not be centralized, right? Like, this is why gold is such a great thing, because no one party or 6 parties or 10 parties controls the world supply of gold, all right? It tends to be distributed quite evenly amongst a number of market participants who can't manipulate it. Let's not talk about the degree of manipulation that happens in the metals market, because that's not necessarily based on the physical. But what you have with crypto is, or with Bitcoin, specifically, you've only got a certain number of coins, and a certain number of coins are held by these whales, these big players that control it. Now, when these big players say something or do something, and it pushes the price up, or it encourages more speculation in on it, you have to ask yourself, is this something that cannot be manipulated? And if Elon Musk can tweet something and crash something, that's a manipulated thing. It's not a currency per se. It's just another asset, and it's just a volatile asset at that. So I think it's lost that currency and that currency label. Mm-hmm. I see it as just a very, very speculative pool. I would say that the percentage of people who trade in it, who actually understand trading as opposed to understanding crypto, I think there's 2 different things there, are few. I think a lot of people get in on it on a WhatsApp message from their buddy at the gym. And I've always maintained, unless you really understand what you're doing, you shouldn't play in the game. And what happened last week was just a manifestation of the rules of trading. If you didn't think that was possible, you shouldn't have played the game. But 400,000 people losing their accounts, that's big. That's very big.
That was I've got some of the Ethereum ETF.
Yeah.
Not too many shares, but
I like Ethereum. I see that because of the way it works, and don't ask me to explain it because I'd probably butcher the whole explanation. But if you talk to people who are very successful in trading, what I've been hearing from them is they avoid Bitcoin and trade Ethereum because technically on the charts, the Ethereum chart has a lot more upside. So, I delved into it. I sort of understand it. I wouldn't say I'm an expert on it. So what I do is we look at it in terms of relative strength. I'm going to pull up a chart and I'll show you what I mean. So when we look at the assets by themselves, the sort of market, what we want to look at is comparative strength between the different asset classes, right? So over here in the bottom left, we're looking at Bitcoin, we're looking at Ethereum, the triple NASDAQ, we're looking at bonds, we're looking at the Dow, we're looking at gold. And what you see weakness in Bitcoin was evident back on the 19th of April. And that's what I was saying to all of our subscribers is we shouldn't be getting in here. And back in the 19th of April, if you go up, if you have a look at the price charts, it was, coming down from at 65, but there certainly wasn't any indication that a 30% reduction was going to happen. But we saw relative weakness starting to form. Now we've started to see relative weakness starting to form in Ethereum. So for us, we keep our Ethereum, we just don't add to it. Now we just wait because that's part of our long-term holdings. But what you see now is strength coming back into Dow and SPX and strength being maintained in gold. So our gold trade has done very well. Our mining stocks have done very well. And then you can see this sort of weakness here in the commodities space. I wouldn't call this, medium-term weakness. This is obviously based on the day chart. This is not based on the weekly. But, if you start following just practical, factual data points about, relative strengths, you'll start to realize that there's a lot more to trading than just a text from your mate. You have to understand, well, how is this compared to this? Because if this is not doing well, why go to it, right? So here we can see technology starting to improve. We can see healthcare maintaining its strength. We can see finance maintaining its strength, consumer staples, utilities are getting some back. The communication, real estate, materials, fantastic area. Mining and minerals, also good. I watch biotech a lot. And, when this starts to shift into this sort of yellow color, I'll be quite excited about that. And we've got a position in IYT as well in the transports. On the currency side, you've got opportunities in Canadian dollar, and you've got opportunities in the franc as well as the pound, like the Swiss franc and the pound. I like the idea of the pound as well. The other thing that we do is we watch the Asian market. So here you've got Hong Kong, you've got Japan, and you've got Korea. And, just like anything, right? If there's going to be a contagion in the stock market, it's going to start there and it's going to, flow east
across
or flow west to us. Right? So the other thing that you've got to look for is a turnaround in China. I think that this is going to be the key because we've had China with a lot of weakness going back to February, right? But now it's starting to look a little less bad. And that's the key, is you want to get into trades a little bit earlier. Okay, so this is my completely, but let me actually open up a more simple chart. Give me a second. When you start looking at opportunities, what you should be looking at is trying to get into these trades earlier rather than later. And what we can see here on China is a definite bottom that was formed over here at the 50% retracement level over here. Then we had the bounce up. So you can see the 3 ATR extension. We were outside of the 3 ATR. We bounced up. There was a move for a recovery to the mean. Then it went up and it hit the blue line. So you see how it hit the blue line. Now it's pulling back. So what we're looking for is for this squeeze. Well, there's no real squeeze here, but what we're looking for is for the momentum to move to the upside. All right. So I've got a bullish crossover on the MACD. My alpha score points have improved significantly, but they're not at the threshold yet. I'm waiting for this to hit 70, and I'm looking for this to break up above. So I'm looking for the green line, which is the 8 moving average, to move up against the 21 and the 34. Right now, we've got negatively stacked moving averages. So we've got the 8, the 21, the 34. It needs to be the other way around. And the only way it's going to get there is for the 8 to sort of get sucked up into this space, which is the easy trade. So we got into FXI. I think we're up around 30%. We got in just over here. And what we're looking for is for China to improve. Now, this is, don't run off and buy China right now. I mean, this is a horrible chart because there's definitely...
That's FXI. Is that which...
This is the large top 30,
okay.
The large cap index.
Gotcha.
So what we're looking for is for FXI to start moving up into this above the mean kind of trade, right? So we want it in this area. Could you add here? Probably. I wouldn't be doing anything until I get momentum moving onto the upside, but we've got a pilot position. And how we trade is we tend to take small positions, like literally $100, throw them onto the P&L and see if that starts to move. And when it starts to move, we can see it, and then we start adding to it as long as the trade is moving in the right direction. So this looks pretty good for a potential turnaround. And I think that that's an important distinction to make, is that not all the good stuff's going to be happening in the US. You have to have a sort of global view. And when you start seeing these potential turnarounds in China, for example, you could also play the semiconductor market by going long South Korea. Those kinds of ideas just, it diversifies you a little bit in terms of your geographic exposure. But yeah, I'm looking forward to it. I think there's a bit of a tech rebound that's going to happen. If we look at the technology index, same thing. Hits the bottom here, extension below the 3rd ATR move, bounces back up. Now you can see how the trajectory of this green line starts to change. It's now turning to the upside. So if we can string together a couple more days to the upside on technology moving up, so potentially getting the green line to be above the 21, not necessarily above the 34 just yet, but above the 21, we could certainly add to this trade. We have a bullish crossover on our MACD. We have our awesome oscillator showing less downward momentum. So there's definitely things telling us that things are going to improve. Our slingshot forming around. So it's not a squeeze, but there's a slingshot on momentum. And look what happened on our alpha score. We went all the way down. We were at 45. We then went up to 90, back to 65, and now we're back up to 100. So, this is the indicator that I put a lot of weight on because it's got 40 indicators underneath. So when that indicator is giving me my benchmark and it's telling me, time to get in, this can often be a really good indicator to get into a trade early. So I think XLK, there's definitely an opportunity there.
When you do a pilot position, do you normally what kind of trade do you put on for a pilot?
Sometimes it's a 90-day long call at $100 at the 30 delta. It's just something small. One of the things that most beginners get wrong is they tend to oversize or undersize. It's like there's no middle ground for a beginner. It's either all or nothing. And the way that you've really got to approach a trade is that all trades start off from the same departure point. It's like, well, I could be wrong. If you approach your trades like, I could be wrong, why would you put a lot of money down up front, right? You build these trades. As trades start earning their stripes, so to speak, you can start putting more money into it. So let's take our Google trade, for example. Our first trade that we did on Google, and our buy zone is always identified somewhere between the 2nd Keltner and the 3rd Keltner, right? So once Google starts to move down below the 34-day moving average, we identify that as our buy zone. Now, back a couple of weeks ago, so back around the 12th of May, you can see what happened at the bottom here. It was performing quite well, and then all of a sudden it started to drop and got weaker, right? So this would have been a hard time to justify getting into a trade. This kind of price action here is really hard to sometimes stomach a trade, right? So if you look at it, that's pretty painful. You know, if you were getting in at the third ATR and you've had this pullback down to -2, this would kill a long option. This kills long options. That's why we don't do it there. We would never be buying there. We would be buying sort of here. You know, this was our very successful trade we did a couple of weeks ago. We did another one over here. We want to try and buy as close to the blue line as possible. We don't want to be buying up here. So as soon as Google starts getting extended at the third ATR, we know it's going to pull back. So there was a pullback. There was a pullback. Now, this was a pretty severe pullback because pullbacks in the past sort of go to the mean and then it comes up, and then it goes to the mean and then it comes up. So here, this would have killed a trade. If you had gotten into a trade up here, you would be dead down there. That whole trade's gone. Now, if you're getting into this trade, there's a certain element of conviction you have to have, right? Because if you go here and scroll down, you had a squeeze firing short, diminishing downward momentum. You had a bearish crossover here on your MACD, and this has also gone down, right? So this would not be a time for you to, you know, mortgage the house and go long. But having looked backwards this way, and you see that this stock very seldom gets to -2 ADR. Very, very seldom, very seldom. You would look at this and go, based on historical precedent, when this hits the 2 ATR, this is a dip buy opportunity on the stock. So you would go long. So what could you go long with here? You could do two things. You could do a long-term, a sort of 100-day, 90-day call option at the 30 delta. It's a lot cheaper. And remember, Google's an expensive stock, right? So buying an outright long call at the money, you know, unless you've got millions, it's an expensive trade. So you could do, what we did was a very, very simple out of the money butterfly. Very simple. I think it cost us $70 or $80. And what we did was we did it for a couple of weeks. So we just took an expected move. We looked at the pricing on the options. We put in an expected move. This trade closed on Friday. We got a 4x on this one. All right, so we got a 400% return on this. Because what we did was we looked at the expected move and we said, you know what? It's unlikely that Google's going to stay down here for long. It's not that kind of stock. Mm-hmm. So we put it in a butterfly. I think we did the 2300 pin for Friday, which was this price level over here. And we went out a couple of weeks and we put it in, done. Now, as that butterfly is starting to work and it's starting to show some profits, and you have your, you know, you've got a wide strike butterfly. So we had a wide one, 2200. We did the 22, 23, 24. So we did 100 wide. Cost us a few $100s. It wasn't a lot of money. You start to see the trade starting to work. So because you've got this wide net, there's nothing stopping you as the trade starts to improve by adding in a call spread in the middle of the net. And you could add a put spread on the other side of the table to finance the trade. So at the end of the day, you've got these multiple positions starting to build up on different expiries based on the movement of the stock away from your original entry point. So you would be moving, you know, over here, you would add a new position and then you would wait a couple of days. Oh, it's still getting better. Okay, I'm going to add another position over here. Oh, it's getting better. I'm going to add another position over here. As long as the price stays between this yellow line and this red line, this is my buy zone. I'm very comfortable building my positions here and taking profits up here. This is where I want to take my profits. But it requires a plan, right? If you're not watching this every day, you're just going to miss it. And then, you know, I'm going to tell you at the end, have you done your Google trade? You know, I missed the thing. So you have to have a list. I have a list of around 10 stocks that I watch all the time. And when setups get built and when setups start to form, where you've got momentum shifting and squeezes building and you've got alpha score points changing around, I'm like, oh, you know what? There's an opportunity that's coming here. I'm going to throw it on a pilot, see what happens over the next 3-4 days, add another trade to it. Oh, it's still working. Add another trade to it. So our Google trade the one that we started back here is currently up 100%. And I think we've got 2 butterflies. I think we've got 3 call spreads, and we've got, I think, a couple put spreads as well. So when you look at the trade overall, and you can see it's not a huge trade, we're not putting in a lot of money, but fundamentally what you've got is you've got varying sort of date exposures, right? So you want to have different days of exposure. So it's going from this week, we've got a trade expiring, then we've got one in 2 weeks, then 3 weeks, and then 52 days. So you just keep building the trade as the stock starts to move here. So you can see this improvement. It went down. This is as bad as it's going to get. You start building. Now it's getting better. You can see the color change in the candles. Things are starting to look a little better. Oh, okay. I can stop building once it passes this line. So once it gets past 23.55, so it's finished building now, right? It's at 23.61. It's going to open up at 23.72. So another nice move to the upside. So that could give me an extra 10, 15, 20% on my trade. So now that it's going to be above the 1 ATR line, all my pricing alerts for exit start to kick in. So these are all my exit alerts, right? So I've already calculated from the position that I've got at what point I'm going to sell every single trade. So as the stock starts to move up now, so we've built it, now we start taking profits. A lot of retail guys won't get into this trade until it's up here or up here, and then it goes woof like this, and now you lose. So there's a degree of conviction you have to have. At this point, down here, you got to have a set of stones, right? You can't just go, okay, I'm going to mortgage the house. You go one trade, add another one, add another one, add another one, and you can see all the while I was adding, signals were getting better. They were improving. There was a bit of an improvement, then a decline. I was like, okay, I'm not going to do anything yet. If the price drops below the second, so if it drops out of this 34 EMA, you see how it hits the end of the EMA line?
Yeah.
It might drop a little lower, but you can see how it touches the bottom of the line. That's what I was looking for. Now it suddenly starts to move, and you'll see the green will come above the orange, which will be above the red. Now we start getting all the green indicators start forming, and we've already built the trade. Whereas a lot of guys are now going to be chasing the trade, and you don't want to be chasing this after it passes this line. So above 23.57, your probabilities of winning become less. So if you build this the right way, by the time you get to the point of ending your build, you should have already doubled your money. This is the way I like to trade, is you should be doubling your money from here to here, and then this is all gravy, right? So if I halve my position now, I take all my risk off the table. I could halve the positions right now, take all my risk off the table. And whilst all the new retail guys are just getting into the trade, I'm already risk-free up 100%. And it's more a philosophy than anything else, right? So, you can only do this really I do it more frequently with Google than any other trade, because the stock itself is just such a huge stock that it's
Right.
not going to go down to zero. You're not going to hear tomorrow that Google's now worth $10. So this is not something, you can't do the same methodology and, multiple positions on something that's a $5 stock. I wouldn't do that. It's got to be a Google or a Microsoft or, a Amazon, Netflix, those kind of trades. You
Big
can't really
established company.
Yeah. You can't do this on, that deli shop in New Jersey that's worth 100 million. Like, you don't do it on the deli. You got to do it on a big group, a big
So those
company.
stocks that are down there in the $5 to $10, $15 range is sometimes, or even less. I mean, with those really low price per share, I mean, is it better to just buy the stock sometimes?
Yeah. Most times, I find there's some trades where the stock, it depends on what you're actually going to do, right? If you're looking at the stock just because it's cheap, that's a bad idea. What you should be looking at is, what are you expecting the stock to do? If your expectation is, well, I think the stock's going to rise over time, and if the next question was, how much time, and they went 6 months, well, don't buy an option, because the time decay is going to kill you. And the volatility, right? So always look at the first thing is, why am I doing this? So with Google, I know that with Google, if we zoom out a little bit and we just increase the aspect here, you can see that this is a trend that's, it goes up, it comes back, goes up, comes back, it goes up. This is one trade. If you actually look at this, this could be, we buy stock down here at 1,400, it's now 2,500, right? So that could be a trade because you want to capture this kind of movement. But during that whole trade, you could buy stock here and trade options on these pullbacks, right? So you've got multiple opportunities to add the option trades over short periods, right? You're not going to be holding those options for long. So accumulating stock, one of the things that we like to do as well is, let's say we make $10,000 on this Google trade, is we'll go and buy five shares. So we swap our profits from the option trade into shares of that stock. And then we're just swapping, these kinds of short-term profits into long-term trend gains, right? So that's another way to play it. But just because the stock is cheap wouldn't necessarily be an attraction for me to trade it, because remember, if that stock drops $2, it's a huge percentage move, and the option can get wiped out like that. So sometimes it's okay. You always start at the bottom. Start with, why am I doing this trade? And are the indicators telling me that the concept behind my trade is valid? If you just look at this graph and you go, okay, well, I'm going to trade it from the bottom left to the top right, and I don't care how long this happens for, well, yeah, buy a share, buy 5 shares, put 10 grand in, and then hold them. Don't sell them at the first sign of weakness, right? You have to appreciate the sort of waves that happen. So
yeah, I also noticed on those really low dollar stocks that the spread on the options is crazy, and the liquidity the open interest is super low. It's hard to get out of those trades.
Terrible. Like sometimes it's just, I have a rule that I try and stick with, that if I'm going to be in a trade very, very short duration, so let's say it's a 2-week trade, I need to see at least 10 times the volume of what I'm trading as open interest. Because if there's no one there, I think there was a couple cases in my career where I've landed up being the buyer and the seller to myself, through my broker. And they would phone me and like, you're not allowed to do that. I'm like, well, how am I supposed to know? I don't know if I'm the actual guy. I'm the guy on the other side that's closing my own trade that I bought. Yeah. It's really confusing. So try and stay out of trades that are going to be difficult to get out of. And this all comes down to your plan, right? If, a lot of people don't plan properly at all. It's like, they'll be sitting at the supermarket in the checkout line and they get a text from whatever alert service they've got, and then they do the trade. Oh, I'm just going to do the trade. I don't, and then they go home and they watch TV. They don't have an exit point. They don't know when the trade's broken. They don't know when the trade's going to be giving them profit. It's a mess. I'm not surprised that 90% of retail traders give back all the money they make, because they're just undisciplined, right? If you want to make money in trading, you've got to have a rationale for every single thing that you do. I'm exiting this trade because that happened. Not I'm exiting the trade because Johnny down the road sold it. Like, Johnny down the road could be wrong. You've got to build a methodology. And this is where I think a lot of guys don't have the staying power, which is why you have a lot of retail traders sort of blow out their accounts and never come back. And yet it's such an easy problem to solve, in terms of being disciplined. So, one of the things that I like to do is I write trade notes. Can you see this Word document on my screen?
I can see that.
Yeah, so I write down, all the things that are in my mind for my trading, right? And like, what am I looking to do? All the things that I'm looking for that week. And this is what I stick to. This is the script that I stick to for the week. And I follow this all the time. So if I'm reading, if I'm doing some work over the weekend and I see something that might be a sort of, reason for next week, something to happen, I'll make a note of it. And then when it happens, I can just tick it off, and I've got my trades. These are the trades that I want to place. These are the ones that I'm looking to buy. This is how you do it. And you will end up being a lot more consistent because you're building a rationale under everything. So it's just interesting to see people's forays into trading and how they start off. And most people don't start off well. They pick up really, really bad habits at the beginning. Exiting too early, oversizing, holding on too late. All of those things become sort of defining characteristics of poor traders, and it's hard to unlearn them. That's the worst thing. It's so difficult to unlearn. And trust me, when I was trading, I made every single mistake in the book. Like literally, I could write a 4-volume encyclopedia on how not to trade based on how I used to trade, 10 years ago. So I don't blame people for getting it wrong. It's just, if there are people out there that know how to do it better, seek them out and ask questions and be sensible. This is not a game of trying to be right. And this is really important. In trading, many beginners want to be right all the time. I'm going to hold on to this because I think it's working. You're not here to be right. You're here to make money. That's the thing. And it's when you make that switch from being right to being profitable, everything will change for you.
So you think that's one of those hang-ups that people have with their personalities, is the people that can't stand to be wrong, end up having a worse time or early on if they won't admit that they're wrong?
I think that there's a lot of that. I remember when I first started trading, and you read a lot and then you plan everything, and then the trade goes against you and you be like, I don't want it to be wrong. Like there's this part in your brain that goes, I don't want it to be wrong. I put so much work and effort into this trade. It has to be right. It has to be, and you sort of pounding the pillow here with your hand, it's got to be right. It's got to be right. And, it goes from -10, -15, -17, -20, -25. How many more signs do you need that you're wrong? The thing is, you can always go back. Like, if it's wrong, you might be wrong now and right later. And I've got some clients that had this experience where they would go into an option, and yet the trade worked out in terms of what their perception of what was going to happen with the stock. But what they did was they had the wrong tool. They bought an option rather than buying the stock. And they were like, well, when would I have bought the stock? I said to them, because your expectation at the beginning was that you wanted the move to happen now. And in the first couple of days, if the move hasn't happened, then the option that you've bought is the wrong tool. You're going to have to buy the stock, because now that option is going to get killed. Doesn't matter what you think is going to happen. That tool is wrong. And this is why with options, it can be quite complex, because you can still be right and wrong. You can be right and lose money. So knowing which tool to use and when, sets up the trade. And this is why you've got to look at a graph and you go, okay, I'm going to trade Google for the next 3 or 4 months. Right? I look at Google and I go, I'm going to be doing this for the next 3 to 4 months at different times, not all the time. And this is what I look for. Boom, boom, boom. And when those things happen, like we had over here, when Google pulls down to the 280R, it's one of my trade rules. If Google pulls down to the 280R, I start looking to build a trade. That's it. I don't look at, is Joe Biden doing this? Is Hamas blowing up something? I don't look at that. I look at, is Google at this point? Yes. Okay, now I can build a trade. I can start to look to build a trade. And then 2 days later, after I've started the first move, has it done this? Yes. Okay, now I can add another one. And then you start building. But to get to that point of being able to sit down and say, okay, with Google, I'm going to do this, this, and this, took me years. It took me years to accept that that's the process for my brain that makes sense. I'm sure if I sat down with people who are better traders than me and told them my methodology, they'd probably laugh. But it works for me, because at the end of the day, I still make money out of it. So it must work. For some, it might not work. But this is the box that I find works for me. And I think for traders, you've got to find your box. You can't just copy someone else's box. You've got to look at the box and go, I'm not comfortable with that methodology. I don't like sitting in front of my screen all the time. Or, I like trading on the weekly charts. I mean, I used to just trade on the weekly charts and I loved it. But I got bored because I wouldn't be able to do anything from Monday to Friday. I've watched every single episode of these damn soap operas. I even started getting into Mexican soap operas. I was so bored. And then that's when I started to realize, like, you know what, maybe I need to build a trade around the daily charts as well. But, you find your box. And that's, for a trader, I think that's the most important thing, is find the box that you're comfortable in. Doesn't have to look like someone else's box. And you just stick with it. If it works and you're making money, don't let win rates be deceptive. Don't let win rates deceive you. This is the funniest argument in trading, is retail traders focus more on win rates than anyone else. But what they don't realize is you should be looking at how much you lose when you lose and how much you win when you win. All this obsession with win rates. Oh, this guy's so good. He had an 80% win rate. Really? And the 20% that he lost $1 million. But on the 80 that he won, he only made 10,000, and you're going to follow him? Like, really? You can have a win.
Big winners and small losers.
What's that?
You need big winners and small losers.
That's what you need. But to get to that point requires a certain psychology. It requires a certain mentality of being okay being wrong. And if you're going in as a trader going, I'm going to be right, I'm going to be the first trader in history that's never had a loss, like, you'll be amazed at how subconsciously so many beginners go in and do that. I don't want to lose. And then you talk to them and you say, well, why did you hold on to this trade that was minus 65%? You know that mathematically your probability of winning on that trade is almost gone by that point. Why did you hold on for the extra 40% loss or 35% loss? Oh, I thought it was going to turn around. Okay, on what planet does that probability actually happen? How many times have you had that? Minus 65% for a turnaround. I think in 20 years, I've had it 3 times. And I do, thousands of trades a month. So
I'm guilty of that. I'm getting better.
It's a hard skill, man.
Holding on to things too long.
I think that's the most difficult skill in trading, is taking a loss. Most people would think, oh no, it's finding good stocks. No, I think finding good stocks and finding good setups is a function of rules, right? If this, then that. If this, then that. Getting out of losing trades as a trader is the hardest skill. And it takes practice. It takes maturity. I've seen people win on 10 trades and hold on to 2 losers and lose all the money they made on the 10. So, those 2 losers can kill your account. So getting out of bad trades is a skill.
For sure. Again, that's something I'm working on is exiting those positions, not leaving them around.
Yeah. Well, look, I'll be honest with you. I think I'm a terrible exiter of bad trades, because even for me, with years of doing this, I still struggle with the whole idea of being wrong. It's a hard realization, considering the amount of work that you do to build trades. But I'm getting better. The last couple of weeks, my win-loss ratio has been closer to my annual goal, which is 2-to-1. For this year, my goal is 2-to-1. I think I'm around 1.6 or 1.7 for the last couple of weeks. And, that's a major step forward for me, major step forward. But you can only get better at that. You can only get better. And it's about having less positions, so there's no distractions. It's having clear-cut rules on exits. And it's being brutal. I could exit this Google trade. So if you think about it, I could exit the Google trade. If it hits one of these alert lines, I'm out. I close the trade. It doesn't mean I can't trade Google again. It just means the trade that I had was wrong. I've now taken my money, and I'm going to wait for it to get to a better entry point, which would be, strangely enough, somewhere down by the 2 ATR move, or at the bottom of the 34 moving average. That's it. You just come back at a later point when it's at a better price. That's all it's going to be. So it does become a little harder for some people to do it. It just takes practice. If you're not good at exiting, just make your position smaller so that if you fail on the exit, you're not risking your whole mortgage. That's the second bit.
I have a question, and this is regarding taxes on trading. And I don't know how it works in Canada, but in the United States, if you trade the same equity within 30 days, you can't deduct the losses.
Yeah. I think it's
So
called a wash trade.
yeah, the wash trade, and I try not to trade the same. If I take a loss, I try not to trade that again for some time. Just
I don't
because
know. It's like, I think what you got to do is, I think too many people look, I'm not a tax expert at all.
right,
All right. I have an accountant, they do it all for me. The way I trade is I trade for a profit. How the tax guys want to attribute that to either being income or gains, I budget my entire trading plan to be taxed as normal income. That's it. I don't mess around with, what are you going to do? Not trade Google because you don't want to have the last loss on Google at the end of the year. You're going to get a net gain on Google and have it taxed as income. I mean, I don't think I think I need to have I would love to have a problem where I'm making so much money that it doesn't make a difference. I just go, what's the worst case scenario? Is it's taxed as income, and I trade like that. You know, I don't spend any time looking at the tax rules. My accountant does all of that. I think that that's a safer way to play.
mhm.
Rather have the tax problem of too much income.
Yeah, that's true. I
Less
mean,
worry.
so what do you see? You were talking about the commodities. Do you think the commodities are still going to be a good play for the medium term then?
Yeah, I think so. I think some commodities are going to do better than others. I'm quite bullish on copper. I think copper has definitely got more potential than gold, per se. Copper with an industrial application as opposed to sort of just a currency store of value kind of play.
Yeah.
I think the one that I really like is silver. So I've got some big positions in silver that I'm looking to get some, except silver tends to operate like I don't know, it's just a little bit slow. It doesn't have the same correlation that it used to have with gold. I think ever since the cryptos became alternative assets, silver lost a little bit of its ability to tag with gold. But silver is definitely a play for me. Copper is definitely a play. The one thing I'm really interested to follow is nickel. Because I think that the nickel market is quite concentrated in a couple suppliers, and nickel is a very important element in the production of electric vehicle batteries together with lithium. And when you look at the sort of global supply chain of nickel, there's only about 5 or 6 big mines of nickel in the world. So I like the sort of limited supply, high demand kind of story on nickel. I think that just because there's a lot of dollars being printed, your grocery store inflation, wheat, meat, orange juice, coffee, all of that stuff, they're all going to go up. It's just the speed at which they go up is going to be hard to determine because I think it can be manipulated. So, when you've got governments putting pressure, in China, they're already starting to put restrictions on how much you can stockpile. So, they're telling you to take what you need, not what you want, kind of stuff. And that always puts a little bit of a damper on the demand. But yeah, I think commodities are definitely a place worth playing over the next couple of months. It's the summer months, eh? Be careful of trading in summer. It's not an easy time to trade. Liquidity starts to dry up. Where you could exit a trade easily in the past, it's not too easy now. So you've just got to play the idea that I showed at the beginning of our call, where you talk about relative strength. Don't just assume because your buddy's in it that it's actually a good idea. Try and stick with things that are seasonally strong as well as performing, right? You want to be in that space, not in what's currently hot right now, because once the sort of cycle from hot to cold, it can happen pretty quickly, and you could be stuck having bought at the top. So, knowing where to get in, build the trades, have confidence to exit when you have to, and just practice, man. Practice as much as you can. This is like any sport. You got to do some paper trading on the side so that when you're playing for real, you can actually, score goals. That's important. And check out rogueinvesting.com/alpha if you want to come and join us. What we're doing.
You've had some really good. I mean, the clients have really good success on there. Some nice wins already. So Yeah, definitely go over and check out Chris's product on Rogue Investing /alpha. Uh, join the service. You'll get trades, you'll get information, and start making money.
Yeah, man, it's all about learning. The whole objective is to make people better traders, to make them independent. It's, take off your dependency from Reddit, and Wall Street bets kind of stuff, man. Please don't do that stuff. It's just bad for you, bad for your health. There should be a health warning. The Surgeon General should put something on there. It's crazy. The bells are going to ring in a second.
Yeah. All right, Chris. Well, we'll call it a day then. Let you get to your trading. And
all right, buddy.
Much luck in the market today.
Thanks, man. I'll see you next week.
All right. Take care, man.
Take care, buddy. Cheers.